It's time for CIBL Biz Tips, bringing you actionable strategies to grow and improve your business. Prepare to become civilized.
What's up, Central Illinois? Welcome to CIBL Biz Tips, where we bring you concepts and strategies to grow your Central Illinois business. Today, we have back in the Zoom recording studio, John DeFreitas and Nick Gentile from Heartland Bank Trust in Springfield. If you saw or listened to our prior two episodes with John and Nick, we talked about lines of credit, how to apply, what it is, what type of business needs it. And I think we pretty much beat it up. So we're going to move on to a little sexier topic. We're going to talk a little bit about investing in real estate. So, John and Nick, if someone is interested in starting their journey down the real estate investment path, what type of a down payment would they expect when they finally found their property, they're ready to pull the trigger, they're ready to meet with you guys at Heartland? What type of a down payment and loan situation are they looking at?
The more the better, Derek.
The more the better.
That's the correct answer.
Great.
No, it's typically in between 15% down and 25% down. It's probably the most common. I think, you know, depending on where somebody's at in their investment career or their firm's investment life cycle, you're obviously going to see different down payments, but that's typically the range.
Okay.
Most banks, and we've said this before, but this is why it's important to talk to maybe more than one bank. I don't know if John's going to like me saying that, but it is true because every bank is different, in terms of what their requirements are and the different terms that they'll allow. But down payment is a part of that, where there can be a little bit more of a range depending on which bank you go to. Typically, your local banks are going to be the best place to start, though.
Nice. So if I'm a newer person in the, I'm just starting my journey. Let's say I'm just wanting to purchase my first investment property. Obviously, I don't have a business, at least a real estate business to back me up and show proof that I know what I'm doing. What are you guys looking for as on the banking side? What are you looking for when I come in to apply for that loan?
Yeah, so sometimes we ask for a resume, or we just want to sit down and talk about what their experience is. Obviously, depending on what they do for their full-time job, that might lend itself greatly to investing in real estate. Even, you might say, well, I'm not a construction worker, but I'm an accountant. Well, maybe an accountant can make sure that the books are neat and they can keep track of everything. So that might be a benefit. But certainly like a construction worker or somebody who's maybe worked for a real estate management company, anybody who's got experience in those sectors, it's going to lend a lot to moving over into real estate investing. If you've never had any experience in any of that at all, you can certainly still invest in real estate. But like Nick just talked about, sometimes if it's a little riskier, maybe we want a little bit more money into the deal. It also depends on the type of real estate it is. Where is it located? What's the dollar amount? If it's property that needs a lot of work, the bank might want a little bit more money in up front, because if we end up owning the property, which a bank never wants to do, then, how much money are we going to have to put into it to make it marketable so that we could resell it and get our money back? So some of those factors are going to change depending on who it is and what background they have.
Awesome. So is it easier? Let's say I've purchased a few and I'm coming back to you for another loan. Does it get easier for you guys to work with businesses who have established experience in the real estate industry?
Yes, absolutely. It's a combination of things, though. The most obvious one is that there's a comfortability there. If you're comfortable with a borrower or a customer that's been doing this for a while, you as a lender, because one of the things that people don't maybe realize is as a commercial lender, we're signing on a lot of those same documents that the borrower is, that the real estate investor in this example is. So we've got to believe in it just as much as they do. So as you start to get more comfortable, that conversation is a lot easier. But also, you've got, if it's somebody that you've worked with for a while, part of the process getting somebody in for the first time is just gathering documents and having those initial conversations about, what their background is. You get to skip most of that if you've got somebody that's been a current customer for a long time. You're going to get their most recent financials and, get their updated personal financial statement, but you kind of get a head start. So it would, from the other side of the desk, I'm a banker, from the customer side of the desk, it definitely is going to be a little bit smoother after the first one.
Awesome.
Yeah, I'd also say with like our executives, every bank I've worked at has said, when you're lending on a piece of collateral, go out and put your eyes on it. So what are you buying? Is it in terrible shape right now? And then once you own those properties, say you own 1 or 2 or 3 of them, I might drive by and look at that property and say, well, it had gutters before, but it doesn't now. That's not a good sign. Joe isn't taking care of his property. But if it seems like it's in constant good shape and it looks like, okay, they're really taking care of this piece of property, that along with building that long-term relationship like Nick talked about makes it a lot easier to just keep the money flowing, make the deals happen quicker. If that's your goal, is to keep growing rapidly, taking care of that property and building that good relationship is a good idea.
How much does the property dictate the terms that you guys are willing to offer? So like if you see that a property may not be in great repair yet, but they're going to fix it up versus, or even like someone who is purchasing maybe a single family dwelling versus a multi-family dwelling, does that change the way or the terms that you guys will offer?
Yes, I think that those terms are guidelines that we go by.
Mm-hmm.
I would say that, if you listen to podcasts or watch YouTubes or whatever on people who are buying real estate and they're trying to tell you how to get out there and make money in real estate, they're going to tell you don't accept anything more than 10% down and make sure you get a 25 or 30 year amortization on a loan or something like that. In reality, a local bank's not going to want to do something like that. If you're buying a $30,000 house, we might only want to go 10 years on it. We might not want to stretch that payment out very far because it's not going to take very long. And you might be getting pretty good rents on that, even though it's only a $30,000 property. The other thing might be with the amount that you put down also, right? We might want a little bit more down depending on the size of the deal. We might expect, 20% down is a lot easier to get on a $30,000 property versus a $300,000 property.
Nice. Well, if you find a $30,000 property, let me know.
Yeah.
Those are hard to come by in 2023, but it sounds like John knows where the hookup is. So,
oh, he does.
Nice. Well, anything else before we wrap up this session that you want to sneak in there?
Nope.
Perfect.
That's what I can think of.
All right. Well, all you listeners, make sure you're subscribing to the CIBL podcast on your favorite podcast platform. While you're there, please leave us a review. It'd be greatly appreciated. Until next time, you can find us on Facebook and LinkedIn. Y'all been civilized. Take care.
Thank you for listening to this episode of the Central Illinois Business Leaders Podcast. You can find us on Facebook at facebook.com/CIBL podcast. You can also follow us on LinkedIn. Don't forget to subscribe and leave us a review. It's the civilized thing to do.